Hello and welcome. This is from the CBN. We bring to you weekly reports and expert analysis of the actions, policies, events, and economic initiatives of the Central Bank of Nigeria, CBN. I am Williamisi Dada. Headline inflation year-on-year rose to 20.52% in August. And to aggressively tame that trend in what can be likened to a case of no retreat, no surrender, the Central Bank of Nigeria's Monetary Policy Committee, MPC, has raised the benchmark interest rate by 150 basis points from 14% in July to 15.5% at the September meeting. The MPC also increased the cash reserve requirement, CRR, to a minimum of 32.5%. In this episode, we have for you high points of the MPC communique as well as the post-MPC media engagement that took place in Abuja midweek, where top officials of the Apex Bank shed more light on the facts behind the decisions of the MPC, all after this break. Stay tuned.
When you run a business in Nigeria, cash collection can be such a big deal. At first, it was just you and the product. And then you have a shop, then 10 more shops, in 10 different locations, in 5 different towns. Wow, that's 50 cash points. And 50 cash points could mean 150 different cashiers to manage. Now, that's a big business. With bigger cash collection demands, that's where we come in. Introducing eNaira Web Wallet. It makes managing cash collection as easy as ABC. Yes, 3 simple steps. We help you with 1. Setup, 2. Onboarding, and 3. Start your cash collection. With all your cashiers on point, all your customers have to do is this. Walk up to a cash point, scan the QR code, the amount, and bam! Your money is here just like that. We provide 24/7 support for any issues that may arise. We're just a phone call away, or you can also email us. No matter how much the business grows, we're here to grow with you and help you collect more cash every step of the way.
eNaira. Same Naira, more possibilities.
Welcome back. Nigeria is not isolated from the continued weakening of the global economy due largely to the lingering disruptions to global supply chain as a result of the Russia-Ukraine war, persisting global inflationary pressure, and lockdowns in China, among other contributing factors. All 12 members of the Monetary Policy Committee of the Central Bank of Nigeria were in attendance at its statutory bi-monthly meeting on Monday 26th and Tuesday 27th of September at the CBN headquarters, Abuja, to review developments in both global and domestic economies in the third quarter and the outlook for the rest of the year. The committee noted that the uptrend in inflation is expected to continue in the medium term in major emerging markets and developing economies, driven by legacy structural issues, elevated exchange rate pressures, rising capital flow reversals, in addition to shocks from the global economy. In Nigeria, data from the National Bureau of Statistics shows that the economy has maintained continuous growth for 7 consecutive quarters following its exit from recession in 2020, driven largely by the sustained growth in the services and agricultural subsectors, supported by policy interventions and credit expansion to the private sector by the Central Bank of Nigeria. However, while output growth remains positive, there was contraction in economic activities.
The contraction was attributed to a decline in production levels, new orders, inventory levels, unemployment levels, and persisting shocks from the global economy associated with both Russia-Ukraine war and the unabating pandemic, as well as other domestic shocks. The committee, however, expressed optimism on the economy's recovery in the short to medium term in view of the unwavering support by both the monetary and fiscal authorities in Nigeria. The committee noted the continued uptrend in inflation for the 7th consecutive month, with headline inflation year-on-year rising to 20.52% in August 2022 from 19.64% in July. The hike in energy prices, such as rising price of automatic gas or AGO, hike in electricity tariffs, as well as the perennial scarcity of premium motor spirit PMS, contributed significantly to the building of expectations, thus pushing up the cost of transportation and production. Other contributory factors include the broad-based insecurity across the country, which continue to dampen production activities generally, legacy structural factors such as inadequate state of critical infrastructure, high cost of importation of essential grains such as wheat, and increased demand for money associated with the forthcoming electoral campaign season. The ongoing monetary policy tightening by the US Fed is also putting upward pressure on local currencies across the world, with pass-through to domestic prices as investors exit this economy to seek higher yields in US dollar denominated fixed income securities. The committee noted the marginal increase of 0.39% in the level of external reserves to $38.46 billion as at the end of August 2022, from $38.31 billion as of July 2022, despite continued demand pressure. Urged the bank not to relent on its various policies put in place to support non-oil exports in order to shore up external reserves.
The MPC says the broad outlook for the global and domestic economies in the medium term remains clouded by uncertainties associated with lingering headwinds, but there is hope on the domestic front.
On the domestic front, available data on key macroeconomic variables indicate that output growth will continue for the rest of 2022, however, at a much subdued pace. Some of these domestic shocks include the high level of insecurity currently disrupting the free flow of economic activities, heightened sovereign risk as the 2023 general elections approach, continued upward pressure on inflation driven by exchange rate pressure amongst other domestic factors. In addition, domestic price development is expected to maintain the current upward trend in light of the buildup of increased spending and demand for money as the 2023 general elections approach. Accordingly, Nigerian economy is forecast to grow in 2022 by 3.52% CBN estimate, 4.20% by Federal Government of Nigeria estimate, and 3.4% by the IMF estimate.
The focus of the Monetary Policy Committee at its September meeting was on the aggressive rise of inflation. Members noted that the Central Bank of Nigeria has injected over 9 trillion naira into the economy in the last 3 years, offering 2-year moratorium for 10-year long-term loan facilities. In the light of persistent inflationary pressures, the committee encouraged the Apex Bank to keep a close watch on the interventions.
MPC was concerned that within a 4-month period, inflation had accelerated aggressively by 280 basis points from 17.7% in May of 2022 to 20.5% in August 2022. The committee was consequently of the view that given the primacy of its price and monetary stability mandate, it is expedient that the focus must be to rein in inflation at this time. The MPC noted that a tight policy stance would help consolidate the impact of the last 2 policy rate hikes, which is already reflected in the slowing growth rate of money supply in the economy. It also felt that an aggressive rate hike would slow capital outflows and likely attract capital inflows and appreciate the naira currency. Members deliberated on the impact of the widening margin between the current policy rate of 14% and the inflation rate of 20.52%. At this meeting, the option to loosen the policy rate was not considered, as this would be gravely detrimental to reining in inflation. The committee thus agreed unanimously to raise the policy rate to narrow the negative real interest rate gap and rein in inflation. Committee thus voted unanimously to raise the MPR 10 members voted to raise the MPR by 150 basis points, 1 by 100 basis points, and 1 by 50 basis points. 10 members voted to increase CRR by 500 basis points, while 2 members voted to increase it by 750 basis points. In summary, the MPC voted to 1. Raise the MPR to 15.5%, retain the asymmetric corridor at plus 100 and minus 700 basis points around the MPR, increase the cash reserve requirement ratio CRR to a minimum of 32.5%, and 4, retain the liquidity ratio at 30%.
If someone calls or sends you a message that you have payment issues with your bank and requests that you reveal sensitive information, end the call and don't click. It might just be a scam. No bank will ever ask you for your personal identification number, PIN, mobile banking password, or your card verification code, CVC. Scammers always sound genuine, but don't fall for their bait. Don't respond to phony emails or SMS, and don't click on any dubious links. Even if the other party calls your date of birth or your BVN, don't give them your security details. If you suspect there's an issue with your account, the safest thing to do is go to your bank or call the number provided by your bank directly. Protect your bank details so no one steals your money. This message is from the Central Bank of Nigeria, CBN.
Thanks for staying tuned. You're watching from the CBN, a weekly program that brings to you reports and expert analysis of the actions, policies, events, and economic initiatives of the Central Bank of Nigeria, CBN. In order to provide further clarity on the decisions reached by the Monetary Policy Committee and attend to questions agitating the minds of media representatives present at Tuesday's MPC press briefing and by extension concerned citizens, the Apex Bank arranged a post-MPC media engagement on Wednesday, the 28th. Attendance was both physical and virtual. Here's how the session went.
Now, the director MPD will perhaps give a preamble and then we'll now take off from there. I have a couple of questions also that I have some people sent in even yesterday we couldn't attend to. So I probably would also put our questions on the border. All right, thank you, Director MPD.
Monetary policy tools are largely to just, manage demand and the money market end, around our MPCs just to, change the behavior of the rates in the money market, the rate at which banks transact within themselves. And that rate will feed into the lending, deposit, and other rates and other fixed income market rates and the rates within the economy. So our tools are only effective in that space. And that's why we said monetary policy rates are for signaling. When we make a behavior there, we want it to fit into other rates that, relate with the rest of the economy. So we had the inflation numbers jumping in that proportion. We had the growth numbers still not moving, from 3.11 to 3.5. Quarter on quarter actually declined to 3.34. So you see those, slow growth recovery. And then the shocks, these external shocks that I mentioned, now came in. So it was clear to the monetary authorities that for as long as we don't tame this inflation and very quickly, then all the gains that we've had prior to this period, including the injections and all this, will be wiped out by this denominator inflation. And that means disposable income of households, of businesses. If you are earning a salary of 10,000 naira in 2020 with inflation of maybe 15%, and now we are doing 20%, that's a proportion of that same salaries because it's not going to change anyway. We'll now be buying you less things. Maybe if you are buying fish and meat before, now you drop to only meat, which is not as healthy as fish, and like that. So you see people falling into the poverty line. I'm making this analog so that people understand that the reason for addressing inflation is not necessarily to please investors, or because, we keep talking about negative real interest rate and all that stuff, but also to look at the most vulnerable groups of the society, those that are within this poverty bucket, because those are that constitute the largest population of the economy. So it's also important that we're looking at the lower end of the market, of the economy, and also looking at the investors and the businesses and the tertiary end of the market. So because of this development, we also have issues around the external sectors in terms of the volume of import and export. Director of Trade and Exchange is here in terms of the capital outflows we witness, in terms of the measures that have been taken to encourage inflows. And so this interest rate behavior also affect that sector, and I think they will talk about that. But so given this, plethora of issues that I've mentioned, the Monetary Policy Committee decided at this meeting that they need to aggressively drive inflation down because of the advantages that I've mentioned, what inflation is the harm it is doing to the rest of the economy, and the need to keep people in their jobs and live a good livelihood.
My name is Sodna Kanodu from Punch. Given the peculiarities of Nigeria, where you have exchange rates, Naira getting weaker relatively, when you have several aspects of the economy not actually adding up, do you think that if the inflation rate is probably 40% tomorrow or next month, that is wise to keep increasing the interest rate? Because these are things we hear from outside. Then finally, the second question is this. I want to know exactly what the CBN plans to do in terms of especially those segments of the economy where this particular policy is going to impact, like SMEs, like the poor, some of the policies you have for the lower rung of the society. How do you intend to ensure that this particular policy does not have a kind of ripple effect on them?
My name is Mark Sipo from Leadership Newspapers. It is good that the aim of aiming or addressing dollar speculation or currency speculation will be achieved with this policy. But are you not concerned that this tightening yesterday could raise rates above 40%, rates in the banking sector? Okay, that's one. Secondly, the CBN governor yesterday said that we should expect inflation to begin to decelerate in the next 3 months. But we know we are just entering an election period where there will be much spendings, and this is towards December period where there will also be spending, and naturally inflation will likely go up. How possible is it to have inflation go down in Nigeria, especially when there is also the supply chain is also affected by this insecurity?
My name is Ruth Solurombi. I write for Bloomberg, and my questions are: so central bank TBs are below monetary policy rates. When do you intend to normalize the? And so again, another one is that central banks, I want to ask about the CBs, central banks, 9 trillion naira lending to private sector. Do you plan to slow down that? What of the government? Do you see any need to slow that on that too?
My questions are around the MPR yesterday, 15.5%, and 35% of the CRL. The impact on loans, so I guess a few directors will answer. The high interest on, I think a colleague asked it earlier. Then the impact on bank income. Director supervision, take that. We also know that because of this decision that was taken yesterday, the stock market would be unattractive in terms of yields. How do we intend to balance all of that? Then the impact on FX, actually. A colleague also mentioned campaign starting today, presidential campaigns are starting today. The influx of dollars that we'll see, or the influx of Naira into the economy. Then I asked that question also yesterday. I don't know if I had a full picture of that answer in terms of the larger impact on the economy growth in terms of the present GDP is at 3% now. Then for Director Yila, 9 trillion naira in development interventions, monitoring and evaluation, because a lot of people have been talking about how do you monitor and evaluate the quality or the quality of interventions you've had in the past.
My name is Bukola Idowu. I write for Leadership newspaper. A popular opinion is that the Ways and Means by the CBN is one of the drivers of inflation. Will the CBN be cutting back on ways and means to the federal government to battle inflation? And then secondly, just like we saw a review of an upward review of minimum interest on savings.
Hello. Okay.
Should we be expecting another upward review in minimum interest on savings?
This is Jeff. Can we have we taken time to decouple the inflation, the headline inflation, to know which component of it is driven by money, by money supply, and what percentage of it is actually coming from supply side constraints?
And the question is, if inflation keeps going up, will you still be increasing the rates? And that's why when I explained in the beginning, I said that the inflation numbers we are seeing now is different. All along, like I said, for the last 17 months or so, inflation has been going up, but we didn't jack up rates immediately. We started jacking up rate when we start seeing the way the inflation, and when our inflation was going up before, global inflation numbers were not going up. So a lot of developments are happening. When our inflation number was also going up before, the GDP was also peaking. So we had, when the inflation was going up before, GDP was down there, we came out of recession. So at that time, we want the economy to pick up to a particular level before it started tightening. So even in the United States, you had this argument that, okay, until GDP gets to this level, employment gets to this level, will tighten. They said it like 2 years before. So the same, analogy applicable to your own domestic economy in a different way. The rate at which the United States has changed, jacked up their rate now. They are doing the 6th one. We're just doing the 3rd one. And don't forget that these countries, their inflation number is not supposed to be above 2%. They are doing almost 9-10% now. The way it even jumped there is, so if we had moved in that proportion, then we'll have been doing triple what we're doing. So the question is, if inflation goes up to 40, are you still going to be moving the rate? It depends on the drivers of those inflation. If we still see that it has to do with liquidity, pent-up demand, then you still need to be curtailing that. This inflation, we are comparing the inflation number and our MPR, and there's a question that relates to the MPR. I'll come to that. So the wider that gap, the less attractive is your economy. And don't forget that we don't have all the finances to drive this economy. We also need foreign capital inflow. So for you to sustain that, even the one you have in the economy, for it not to go out, because if it's going out in a very aggressive way, your currency will further depreciate. And when it depreciates, it's entered inflation. So the inflation will still go. So things are related. And that's why I said there's need to be an organized way of thinking for you to be able to understand that space. So that is the point. So how does this not affect, yes, SMEs and small and household industry? The point we're seeing here is that, the quantity of money within the system was too much for the economy to absorb in terms of the flow of supply. So those huge money within the system will either impact on what people say there's too much money chasing too few goods. So that means the prices will go up just because of the volume of money within the system. Or it will also go to demand pressure on our FX. And as the Naira depreciates, so also will inflation numbers be rising. So we're looking at all that bucket. And as also the interest rate becomes too low within the system, so also it's unattractive for investors to bring in their funds. The banking system operates with inflows and outflows in terms of savings and then lending. So you can't lend unless people save or investments come into the space. So you also create room for those investments to come for you to be able to lend to the rest of the economy. So there's a recognition of the fact that there are, vulnerable, and that's why I explained that the target at inflation, taming inflation, is also to deal with this vulnerable goods obtained in the because even if you allow growth and production to go up and you make earnings, the increase in earnings is wiped away by inflation. So you are not really getting any. So it's good to tame that inflation so that the disposable income, that is the income available for you to spend, has value.
That's all from the CBN this week. You can report on reserved banking issues to the CBN Consumer Protection Department using the email address cpd@cbn.gov.ng. Attach relevant documents. Call the CBN Contact Center on the phone line +234 700 2255 226. Local call rates may apply. Send your inquiries and comments to the dedicated email address from the cbn@gmail.com. Follow us on Facebook, YouTube, Instagram, and Twitter for updates and to watch uploaded episodes of the program. We invite you to join us again next time. I'm Mulia Misi Dada. Stay safe and bye for now.